Welcome to the classroom. Please like, share, and subscribe to our channel.
Hi, this is Vusi Thembekwayo, rockstar venture capitalist. So I thought I'd share with you 3 quick tips to take into consideration when starting your own business. The first tip is don't write a business plan. Just don't waste your time. Don't write it, don't go through the process, don't even consider it. The most important part of starting a business is the start. So what you've got to do is once you've figured out there's something you're thinking about or something you'd like to do, is to start testing it. If you want to start selling chappies at a street corner, buy some chappies and start selling them. If you want to start supplying a certain company with something, buy the stock and then go and start supplying them. Don't go through the process of writing the document until you've tested something and you kind of understand what's happening in the market, because once you start writing the business plan, you have context and broader knowledge. That's the first thing. The second thing is to remember always, and this is the most critical thing for people starting businesses to remember, there's a big difference between being self-employed and being an entrepreneur. Being self-employed means even though you work for yourself, you never have freedom because you work 18 hours a day, and if you're not in the business, there is no business. If you really want to be an entrepreneur, up front, as you start your business, you've got to start thinking about how do I replace myself in the most important parts of the business. So how do I get somebody to do the sales and I can manage them? Somebody to do the finances and I manage them? Somebody to do the marketing and I manage them? That's really the difference between being self-employed and entrepreneurship, and those two are not the same thing. And the third and probably the most important tip I can give you is always do something that's important to you and something you feel passionate about. And the reason for that, and I'm sure you've heard it before, it sounds quite fluffy, but the reason for that is simply this. There are often times in the early days of the business where the only thing that's going to feed you is the passion. Because there is no money. The clients pay too late, the suppliers want their money up front, your costs are always higher than your income, and you've got almost important costs that you've got to pay up front, salaries, rentals, etc., whilst you're earning the money much later on. And so enjoying what you do and loving what you do is often going to be the only important thing that keeps you doing what you do. So always make sure you do something that's close to heart and not necessarily something that you understand or something that you think you can do purely because there is a market potential. If it's close to heart and take it from experience, you're going to keep doing it for much, much longer. I wish you well in your business journey, and remember, if it was easy, everyone would do it.
Many people do not do accounting because it may be too difficult or it has too many calculations. The reasons are many. Well, if you are going to be in business, you must understand that finances are integral to the business. And having a well-developed grasp of accounting concepts and how they may show the success or failure of a business, you will be equipped to build a successful empire. In this chapter, we are going to look at basic financial concepts, the importance of investments and insurance for a business, and the importance of feasibility studies. You do not need money to start a business. If, however, you are lucky enough to have the money or smart enough to have somebody else believe in your ambitions, then things can be a whole lot easier. You should have an understanding of everything to do with own or borrowed capital, where if you start an unregistered sole trader, you put up all your own money and assets to get your business going. If you cannot do that, then you may have to borrow money from different institutions or people, or even go as far as converting your sole trader to a partnership or a private company, and eventually converting that very private company into a public company so that you may be able to sell the shares in your business in order to get money. Either way, the ultimate objective is that your money must work for you harder than you will have to work for it. How can this easy sounding yet difficult feat be achieved? For starters, the first thing that you must know is the difference between profit and cash. Secondly, you must figure out whether you are investing some of your excess profits to generate a monthly income, or are you perhaps after capital growth? One of the most important calculations in this case is the return on investment. This is a simple ratio which gives you a percentage based on the difference in the money which you have invested and the money which the investment has generated for you. This ratio will help you determine many things, such as: is the investment better than other investment opportunities? Or is the business actually generating a healthy profit? The bottom line, one of the elements of the triple bottom line.
Sometimes the investment doesn't pay off.
There are many different ways to make your money grow. And the more technology improves, the more we may find different ways of investing. The basics of investments lies in looking at the major asset classes and some of the risks associated with them. This is mostly considered a low-risk investment, and in such it is considered to generate low rewards. But do not write it off. A money market instrument can, depending on prevailing conditions and circumstances, outperform a riskier asset class in the space of a year or two. Your plans, your age, your risk profile, inflation, and fees and charges should be considered before making such an investment. Property can generate a modest return because it is considered a moderate to high risk asset. It is said that property does not depreciate, it appreciates. I personally find this to be incorrect. Properties fall apart if they are not taken care of. However, if they are, then the value will most certainly keep pace with inflation and more. This will only hold true if, depending on the property portfolio, you, the trustees, the board of trustees, or the managers are taking great care on maintaining the properties. Bonds can be defined as interest-bearing securities issued by the government or companies in order to borrow money from investors. The risk profile here is considered moderate. Equities may be called shares or stocks, and they are bought for part ownership, for growth, and in certain cases for income in the form of dividends. Out of all the asset classes, over the long term, you may receive returns which may far outpace inflation. However, the risk of losing your money is also high. So many different criteria may help in recognizing whether a company may be a good investment. Some of them are: the type of industry in which your business operates in. Some industries can be evergreen, whereas others can stay dry for many years. Compare retail stocks to cement stocks over a period of 10 years. You will see what I mean. The strength of the brand may also keep the share price high. Take a look at the share prices of the 3 biggest retail stocks in South Africa over a period of 10 years. You will see what I mean. The management team may influence the share prices of certain businesses. A great example of this particular issue is when Elon Musk offered to buy Twitter. The share price bounced around harder than a toddler on a sugar rush. The liquidity of an investment is an important factor to consider when investing. This refers to how easy it is to change your shares into cash when you need it.
This is the end of part 1. Thank you so much for watching. Part 2 will be up shortly, so stay tuned for that. If you haven't subscribed, then please do so by clicking the subscribe button and turning on post notifications so you never miss out on a video.